The goal of this presentation is to help you understand L&M's hedge fund investment, how it has performed historically, and what the costs are for the Lawrence Memorial Hospital network. As of the end of September 2008, L&M had accumulated $166,184,727 in investments, mostly held in traditional investment vehicles like stocks and bonds. Beginning in 2009, L&M shifted a total of $45,696,984 into what are known as alternative investments, a class of investment vehicles which includes hedge funds, private equity, and real estate. This shift in investments occurred over the course of 3 years, with L&M investing around $20 million in fiscal year 2009 and fiscal year 2010, and an additional $3 million in fiscal year 2011. While we do not know the exact date of the first hedge fund investment, it's important to note that it occurred between October 1, 2008 and September 30, 2009, roughly when the U.S. stock market was bottoming out. Why did L&M reallocate so heavily into hedge funds? Let's talk a little about what a hedge fund is. Hedge funds were designed to be high-risk investments for the very wealthy. Because hedge funds have long been seen as boutique investments for the very wealthy, they have less regulatory oversight than other types of investments. Additionally, with a hedge fund, you are not investing in a particular company or commodity, but rather with a hedge fund manager or a group of managers. Investors also invest with hedge funds because they believe that hedge funds can outperform the market. That has been the perception for some time. The reality is that hedge funds often do not outperform the market. Here's just one example, and we'll talk about some more. In 2008, Warren Buffett bet $1 million that the manager of the hedge fund Protégé Partners couldn't pick 5 hedge funds that would outperform on average one index fund that Buffett could pick. As of this year, Buffett's selected index fund is up 8.69% overall, while the 5 Protégé funds are up 0.13%. This isn't exactly a secret. The underperformance of hedge funds as an investments class has been explored recently in Business Week, Rolling Stone, and in several books and academic articles. A July 2013 Bloomberg article compared hedge fund returns to index funds, which are cheap ways of investing across an entire basket of companies. They found that hedge funds failed to beat the market 8 years out of 10. L&M's hedge fund investment has underperformed major stock market index funds. L&M's performance can be seen here in red, trailing Vanguard's total stock market, VTI, the Standard & Poor 500, the Dow Jones Industrial Average, and the NASDAQ 100. Taking a look just at Vanguard's total stock market fund, an investment product that represents the entire U.S. stock market, we see that L&M's hedge fund investment underperformed this index each year. And Vanguard charged a lot less in fees, just 0.1% as of August 2013. How much do hedge fund managers charge for fees? Hedge fund managers can take as much as 3% of the money you invest each year in fees. 3% is actually at the high end. L&M's hedge fund managers are invested in funds that take an average of 1.5%. 1.5% may not seem like a lot of money, but if you have $67 million invested, that's $1 million per year. From the profits that hedge fund managers earn for their clients, they take an additional percentage. This fee can be as high as 50% of the annual returns. Again, that's the high end of the spectrum, with 20% being more common. L&M's hedge funds take an average of between 19.5 to 20% of returns. Combined, these fees mean that hedge fund managers must consistently beat the stock market by 3 or 4 percentage points just so their investors can break even. On top of this amount, some hedge funds charge expenses to clients, which just adds to the costs. To give you an idea of how these costs compare to a traditional investment, let's say that an organization has some money to invest. If you think of a traditional investment as a pipeline, the investor puts their money in and it's used to fund businesses, construction, real estate, ideas, and innovation, the production or extraction of raw natural resources and materials, or the production of consumer or industrial goods. Those investments stimulate the real economy. They employ people, they produce innovation, and they create tangible goods. Profits from the use and sale of those investments flows back to the original investor. And a small amount of money goes to a broker or middleman who facilitates these transactions. Overall, this is a virtuous cycle. Investors make money, businesses generate goods and innovation, and only a small amount is lost to transaction costs. A hedge fund investment works almost the same way, except more money flows out of the pipeline due to higher fees. This often means less money invested in creating jobs and innovation and a lower return for the investor. The money that hedge fund managers make goes to buy yachts, houses, and other rich person stuff. Getting back to L&M. L&M's hedge fund investments are actually in funds of funds. Essentially, L&M pays a whole additional level of managers to invest in a variety of hedge funds. When you invest with a fund-of-fund manager, you're essentially paying someone else to invest in several hedge funds for you. This essentially layers on another set of fees on top of what the hedge fund managers charge. L&M pays two fund-to-fund managers, Archstone Partners and Forrester Capital. These charge fees equal to 1.5 and 1% of the invested assets each year. So instead of a system that looks like this, you end up with this other layer getting skimmed off. We know that over the last 4 years, L&M has paid out $387,781 in fees for their hedge fund-to-fund investments. This averages to 4.15% of returns, and it doesn't even count the fees paid to the underlying funds. Had L&M invested in VTI at the same rate, they would have earned approximately $14,765,482.23 more for their investment. That would have saved the hospital more than $280,860.92 in fees. Budgets are a reflection of values. When L&M chose to pursue a high-risk game in the hedge fund casino while laying off their workers, what message were they communicating about their values? And what could an extra $14,765,482.23 done for L&M? One more issue with these hedge fund investments. $22,428,676 was frozen for 25 months after the investment. L&M could get their money only 4 times per year, and only if they gave 60 days notice. $15,126,804 was frozen for 1 year. L&M has the opportunity to withdraw their funds once per year with 90 days notice. To summarize, L&M made a bad investment which did not return as well as investing across a broad index of U.S. companies. For this lousy investment, L&M paid almost $400,000 over 4 years, not counting additional fees paid to individual hedge fund managers. And L&M is limited as to when they can withdraw the money they invested in hedge funds. All of this leads to a single fundamental question. Is this the best use of patient care dollars? Tell L&M Corporation that we deserve better for our community hospital. Sign the petition online today.